Meet Brandon, a stock market prodigy at just 18 years old. Brandon, a teenager from Toronto, successfully tripled his initial investment of $48,000 to $147,000 in just 2 years by employing a unique and focused approach to investing. As you can see, this is from the Telegraph and Yahoo Finance article discussing Brandon Fleischer proof of success. Instead of following the conventional strategy of investing in large-cap stocks or mutual funds, Brandon focused on small-cap stocks. He preferred these because they were more reactive to market news, making it easier to anticipate price movements. He also prioritized stocks of companies whose leadership was accessible, enabling him to gain insights into their management and vision. Small-cap stocks are known for their high-risk nature, but they also offer significant potential for high returns. Therefore, to tackle on such a high-risk nature stocks, he need to conduct a very deep research on the market and the company. The main takeaway is that the teenager prioritized thorough research before making any trading decisions. Here's a summary of the key areas he researched to earn over $100,000 in the stock market. To adopt his strategy, it's important to understand these critical aspects he focused on. Therefore, here are some key aspects you need to research about the stocks you're considering buying. Let me break it all down for you and explain how it works. Rule number 1, only buy undervalued stocks. Discounted cash flow, or DCF, is a method to figure out how much a company is truly worth by estimating its future cash flow. It's like looking into the future to find hidden gems in the stock market. To find the DCF value, you need to calculate a complex financial model that involves analyzing a company's historical financial statements, cash flows, and interest rates. The final result of the DCF calculation is the enterprise value per share, obtained by dividing the enterprise value by the total number of outstanding shares. For example, in this case, the DCF value per share is calculated as $16.94. If the stock's market price is $12, below $16.94, it is deemed undervalued, making it an attractive buy recommendation for many analysts. However, identifying undervalued stocks using DCF alone is not sufficient to guarantee success in the stock market. Other critical factors, such as analyzing historical price movements, trends, technical indicators, news, and demand-supply dynamics, also play a significant role in making profitable investment decisions. Rule number 2, only buy highly demanded stocks. On the other hand, supply and demand drive the stock prices we see every day. When more people want to buy, prices rise. When more people want to sell, prices drop. Together, these tools can help you make smarter investment decisions. You may also need to examine the chart's technical indicators, such as RSI, MACD, Sharpe ratio, trade volume, and historical price movements. In the next videos, we'll explain to you how those technical indicators are related to the demand and supply curve. Follow our channel for more insights and visit .com for expert stock recommendations. Rule number 3, combine the first two rules. Buy only undervalued stocks that are in high demand. Even with a strong DCF calculation, understanding supply and demand in the market is key. Stocks with high demand and low supply are more likely to see price increases, creating profitable opportunities. If the current market price is lower than this intrinsic value, it's undervalued and a potential opportunity. So, if you see the price drop, don't panic. As long as the stock is undervalued, the price will eventually go up, whether it's tomorrow, next month, or next year. If the latest news highlights strong financial performance from the company, the stock price is likely to rise again soon. Visit investingas.com to let our AI notify you about updates related to the stocks you've purchased, keeping you informed and ahead in the market. Combining these insights helps you maximize profits. Rule number 4, be quick. Opportunities in the market don't last long. This means you need to find undervalued stocks that may have recently dropped, are in high demand, and have positive news driving them. To beat the market, you need to apply all the rules within fractions of a second, something only AI can achieve efficiently. To sum up, all you need to do is to quickly identify undervalued stocks with high demand by analyzing whether the chart shows a bullish trend, especially if it has a high Sharpe ratio. So, you'd need to calculate the DCF value for every stock in the market and analyze each of their technical indicators. This can be incredibly difficult, almost impossible. But don't worry. We've developed for you, your personal investment manager powered by an advanced artificial machine. Let investingas.com handle the complexities of analysis so you can focus on your goals while staying ahead in the market. You don't even need a college degree to manually calculate the DCF value anymore. You also don't have to search through the whole market one by one to find its technical indicators. Because only AI can scan the entire stock market and analyze data in milliseconds. At imam.com make it easy by providing all the undervalued stock recommendations with just a single click. You can find all the recommended stocks according to the last 4 rules and access all of that information in just a millisecond. So, check the link in our bio now.